Now that we've gone through U.S. demand and what U.S. products are doing, we want to look abroad because, we've had a big cap on some of our exports in general, and that's something that we think is going to remain throughout the system, especially because Latin American demand continues to be slow. European demand continues to be a problem because we normally export our distillate into the European theater and our gasoline into the Latin American piece, and we're just not seeing that demand, which again is pushing onshore. But as we talked about in the first segment, the arbitrage is open into the U.S. So why would the U.S. look to export product when we have a very healthy market here? So it's obviously cheaper because you don't have to pay for shipping, or at least boats, because you're still going to pay for pipe shipping, but that's getting complex. But just looking at kind of where things sit right now, we can see gasoline exports were down 97,000 barrels. That's something that's going to remain kind of at this level when you look at the year-over-year 5-year. This is where we think there's going to be additional pressure. It's just in the next few weeks, we're going to kind of flatline at this point. Distillate had an increase of 213,000 barrels a day. That will reverse lower. But again, we're going to stay at this very low level, as we'll talk about in a minute. Jet had a small increase of 49,000 barrels a day. But again, this is something that's going to remain fairly capped. And then propane is still hanging in at about, down at 98,000 barrels. But again, it's still within that parameter of just timing when that goes out, because we still see some elevated demand in Asia, even though it has started to slow down, because we are seeing some pressure in the Indian and Asian markets. And more importantly, when we look at crude oil exports, they fell 113,000 barrels a day, kind of below our threshold of that 2.6, 2.8. This is something that we're just going to stay locked at these very low levels versus the year over year, which is down about let's call it 1.8, 1.9. And that's where we think there's going to continue to be pressure, as our crude just doesn't have the same type of appetite, because there is more competition specifically in Europe and Asia, but also because there's just less demand from a refinery standpoint, which is going to keep some of this crude in our storage tanks. Now, on the flip side, on the longevity of it, there will be more demand. India is trying to diversify more away from the Saudi Arabian side, which we'll talk about in a minute. And that's going to they're going to look to pull from the U.S. in general instead, as just one of their other options. Now, getting a bit more granular here, you can see gasoline is following the seasonal trend over the last 9 years. This is something that we think is just going to continue to trend to the lower end that we saw at the beginning of the end of February, and just maintain some of this depressed levels, just because there remains problems in very much Brazil, just because of the COVID issues and some of the additional lockdowns, which again is just going to impact where their demand sits. Then when we look at just how much European gasoline is coming to our market, this kind of puts it into perspective. On weekly, European gasoline imports are back to a 5-month high. And if you calculate all of the boats coming in general, we're actually at a May 2018 high. So if you think about May 2018, that was really the peak. And we're essentially at the peak of gasoline demand, which is going to keep our tanks fairly full, even as we start to see an increase in demand, as we have March driving or spring driving starting to ramp up along those seasonal norms, just at kind of that factor lower. So again, this is going to keep that arb wide open, especially as we have European problems, and they're at all-time highs. So again, that's going to keep that product moving into our markets. And here's when we look at fuel. So here you had that bounce off the low. We were expecting a bounce, this was actually a little bit higher than we were expecting. But again, you can still see that we're still well below, and now we're going to go a bit sideways, still remaining well out of the bottom of the cloud, forming that new low as we go through, really through the rest of March, and easily into the beginning of April, just because the weather isn't cooperative in terms of heating oil demand, and you just have that lack of demand in Europe, as we do have more Asian cargoes coming into the European theater, specifically from India, some from Singapore, but we'll talk about that in a minute in general. Then when we look at crude oil export data, this is what we were saying, where obviously we're still going to be above the 5-year average just because we started from such a low point. So the average is skewed to the downside, but we're just going to stay kind of fixed within the middle of this cloud as we continue to see that pressure on our oil exports. Then when we look at propane in general, as we've been saying with the propane side, this is one that's going to remain fairly strong just because, again, there's that demand in the market. We continue to see some of this pull through, and where this is going to go over the next few months as we continue to see this demand in general stay fairly stable in the Asian theater. So then when we look to what's happening abroad, we want to look at first the crude in onshore Europe. You can see it's continuing to move to the upside. This is what we were saying with the shift from cargoes offshore to onshore. Now the problem is with this renewed lockdowns, this increase in COVID cases, you're going to see this continue to trend higher as refiners just don't have as much activity. So we're going to continue to see this trend. It's when you look at that 5-year average, we normally see these builds. It's just the builds are happening at a multiple higher, and it just means that we're going to push closer to the top of the cloud before we start to see some of these increases and just general activity. Now, when we look at Fujairah as kind of that stopping point, total stocks rose by 1.25 million barrels, which is that rebound off of the lows that we were talking about, which is about 7% week over week. And it was really the two sides that saw the biggest increases was light distillates, which saw a rise of 1.03 million barrels, or almost about 15.6% week over week, because the East of Suez gasoline market remains under pressure as that COVID-19 resurgence happened in the West, where rising infection rates were seen in some locations. Again, this is a European problem. This is a U.S. issue in terms of where some of these movements are. And that's why the gasoline side is going to be complex, because we have so much of it in Asia and Europe that it's going to kind of compete to come into the U.S. markets. So stocks and middle distillate fell 249,000 barrels or to 3.5 million, down 6.7% on the week. So this is a net positive, but the problem is the gas oil market remains under pressure as we do see more exports coming from China and declining demand in India, which is going to shift more of these cargoes into storage. So that China side is going to be the one to watch, because we remain concerned Asian demand in general. India gas oil demand contracted for the second consecutive month in February, which fell 3.79%. And so far through the first 2 weeks, that's I was looking over here to pull it up. So far in the first 2 weeks of March, we've actually seen again that decline on a month-over-month level. Sale of diesel remains flat, which is a net negative if you consider of how low it was, because February was a 6-month low. Then when we turn to heavy resid, rose 468,000 barrels, rising 6.1% on the week to 8.1 million. And in the port of Fujairah, higher demand coupled with tightness of supply was driving prices up. So people just didn't buy as much just because prices were elevated. So that's something that we think is going to remain fairly tight. When we shift to the market in general, now that we can look at just some of these new loading schedules. So the ones that we want to call out first is starting with March. So here you can see Angola remains struggling to sell cargoes. They have an increase in April, but they actually cut May. They've had to sell some of their cargoes at now a 50-cent discount, where at the end of February it was at a 10-cent premium. Again, just showing kind of that Asian issue that we keep talking about, because Angola sells a large portion or the lion's share of their crude into the Chinese markets. And then when we look at Nigeria is something very similar, which is why when we look at West African floating storage, that's the one that we think is going to continue to drive higher, unless we start to see some of these price discounts coming through. Russia's been a very steady increase. They're at 3.3 million. And as we've said, that we think that they're going to get to about 3.4 as we get into the April loading schedule, as they've started to come out. And then when we look at Norway, we've seen a little bit of a pare back, but again, there's a little bit of work that's happening. So that it's something that is more of a seasonal thing. And if you consider what's happening in the market, and we talked about this last week, there's actually going to be a big increase in refinery downtime, refined downtime in China specifically, which is just going to cut some of this demand, which is again being rolled out, and we're seeing that represented in Angolan schedules and some of the North Sea schedules in general. So the Urals, they had strengthened back to about $1.90, discount of $1.90. They fell down to about $2.45, a discount of $2.45. Now they're at about a discount of $2.35. So again, we still see a lot of physical crude weakness, which is going to be a problem for U.S. exports as we continue to go forward. And just to kind of put that into perspective, so when we just look at what was being sold in April, so like we said, there was for mid-April, we had the lowest at a negative 245, then a negative 235. Now we're at about a negative 215. So again, we're staying within this 215, 245. Now the current market is showing about 10 cents worse. So we're kind of getting within this comfort zone. And then when we look at Unipec on the Angolan side, we're seeing that there's actually a discount of $1 to dated Brent after being at less 90 cents. Just to give you an idea that we had a cargo go off at negative 50 cents. Now we're seeing some offers out there at negative 90 cents, negative $1, just to give you an idea of how much crude they're trying to push into the market, with additional cargoes trading at negative 60 cents and negative $1. Now, one of the things that we always have talked about, but this chart I thought was just important just to put it into numbers. This gives you an idea of where that OPEC spare capacity currently sits. So when you think about how quickly does it come back, how much of this is real, this is where we sit on the spare OPEC production capacity of about 7.7 million barrels. And it's just going to be a matter of how quickly does this come back to market and how much of it is actually real and can come back. But you can see is when we go to the 2014, the end of 2010, when we had some of these increases, we're still at this record high. And as some COVID issues start to arise again in Asia and Europe, you get an idea of just kind of where we currently sit in terms of just what crude is in the market that could come to market at any real given time. Now, when we look at Libya, we just wanted to again rehash where things sit, as there is a lot of stability right now. And just to kind of give you a quote, on Monday, the country's first unified government in 7 years was sworn in as efforts to reach a formal peace gathered pace. So now we're starting to see that they've actually appointed an oil minister. First time in a long time, again, just showing a bit more of that normalcy as we start to go forward. So it could further steady the oil industry in Libya, home of Africa's largest reserves, and reduce the chance that militias restart fighting or close Libyan ports. Libya's oil and gas production will likely remain stable, and the odds of broad conflict remain relatively low. And again, this is why we think their target of end of year 1.5 million barrels a day of production is very doable. It's going to take money. It's going to take time. Not saying it comes quickly or cheaply for that matter, but it's something where there is an incentive to bring this back up, which will again keep that pressure on the European theater, again capping some of those U.S. exports. So then when we look at just what is happening on a global level, again, just thinking about where Libyan crude is headed, where some of those pressures remain. So South Korean crude shipments fell 13% to 10.1 million tons last month, the lowest since November. Oil from Saudi Arabia was up 7%, but from the U.S. was down 26%. That's going to start to reverse as we head into June. But again, that's going to remain the case for the next few months, which is a bigger problem because South Korea has been one of the bigger buyers of U.S. product. I'm sorry, for June arrival, which means that it'll get loaded in May. So that's where we'll start to see some of those increases. Global onshore stockpiles of crude continue to drop in general. So now this is looking backwards instead of going forwards, but just to give you an idea, inventories have fallen at a rate of 367,000 barrels a day this year, about half the decline of 770,000 barrels that was seen in the second half of 2020. As we see that pace slow, and now we've actually seen that reverse with the Texas storm and what's happened within some of the other Asian and European theaters. So the other thing is OPEC exports increased 665,000 barrels a day in February, despite the group's pledge to limit output. Again, this is because Saudi Arabia, even though they cut production, have maintained a fairly stable export market, which is just going to be a bigger problem, especially as Libya has been able to maintain about 1.2 million barrels a day. So that's kind of where we sit right now. And then South Korea has actually started exporting 300,000 barrels of gasoline to the U.S., so which is for the first time following increases in demand. So South Korea is exporting gasoline to the U.S. for the first time ever coming into Pad 5. So again, you're just getting an idea of how much gasoline is in the market, and the U.S. market is the best market right now. So it's going to continue to attract some of these kind of stranded barrels at this point, which is going to keep things flowing through. Now, we keep talking about Saudi Arabia, but I just wanted to show, where January was, where February was in general, and then that first half of March. So observed exports in the first 15 days of March were 6.1 million barrels a day, compares with the revised 5.9 million barrels a day of February. So they have a million barrel a day production cut, but they're still maintaining exports that are flat to slightly up versus January. Again, that net problem that we're seeing of just taking it from one storage tank to another and calling it a cut. But again, these are things that we want to continue to look at because we think this is going to be a much bigger problem. Then when we start looking at some of that Indian data, Indian demand diesel from February was 1.55 million barrels a day. First 2 weeks of March were about 1.41. They've closed it a little bit to come in just below that 1.55. But remember, diesel demand was at a 6-month low. Gasoline for February came in at about 680,000 barrels a day, which is just slightly above where we were for gasoline. Again, this is going to kind of weigh in terms of where we sit in general on some of that demand, specifically into Asia. Now, the UAE, we've been talking about how the UAE is very, very angry at their situation. So the UAE's output target is the lowest among OPEC countries relative to the production capacity. So one of the things that they're looking to do, and this just looks at where they should be versus the 100, and UAE is clearly sitting at one of the worst perspectives. And the component that they're looking to toss around is relinquishing is taking away specific conditions. And what are those conditions in general? So typically they're called destination clauses. So when you sell a product, so for an example, UAE sells to China, sells to India, sells to Europe. So say, let's just, for argument's sake, Germany. So if they sell to China, they don't want India to take their cargo, turn around and sell it to China. They want to make sure that they're selling their cargo so there's no resale capacity. The UAE is looking at taking away that. So the increased flexibility and bigger pool of potential buyers will improve the appeal of the UAE's crudes over those of its less flexible neighbors. So again, this is a bigger issue. So until now, the big OPEC producers of the Persian Gulf, Saudi Arabia, Iraq, Iran, Kuwait, and the UAE have sold their crude under strict terms and dictate where it can be delivered and prevent its resale by the original lifter. Again, this is where we start to see some of these cracks in OPEC and some of the pressure as the UAE, as we talked about last year, the beginning of this year, they still remain annoyed of their current situation. And this is one to watch in general. Now, when we start looking at what is happening on the water, crude oil on the water still remains above the 5-year average. The issue right now is we're getting a drop in oil in transit, an increase in oil in storage as crude going from transit goes into storage. And then there's that delay into the onshore component or the offloading. And here you can see oil in transit has fallen below the 5-year average just based on slowing demand, some of these issues that we keep seeing arise in just, refinery turnarounds. Oil in transit will remain depressed just because there's just less buying happening, which again is going to increase the floating storage as we do see the refinery turnarounds increasing and that elevated level of refined product and storage. So then when we look at oil floating and storage, here you can see we still remain at those highs. Just to give you an idea, the amount of crude oil held around the world on tankers that have been stationary for at least 7 days fell to 102.5 million barrels, which is, so far this year, which average import volume so far this year is about 3.8 million barrels a day. Again, this is kind of showing you just how elevated we are because we're still well above the top of the cloud, setting those new seasonally adjusted all-time highs. You can clearly see when that changed in April. But again, you're seeing kind of where this pressure is. And now the issue is, what happens when there's a new OPEC meeting, physical prices remain weak? Will they continue to maintain some of these cuts as we do see gasoline prices just pushing higher? India, they remain at all-time highs. And in the US, as we talked about in segment 2, continue to push ever higher week on week and year over year. So then when we talk about what's happening in Europe, here you can see that gas oil is now back below this call it 15-year average, and they're actually going to start importing a bit more from India. So when you look at where some of these imports are, they're going to be coming from Asia and really not from the U.S., keeping U.S. exports fairly flat, flattish from here. Let's put it that way. But the bigger issue remains that gasoline side, just because gasoline continues to push higher, even though we're having a record amount or a May 2018 record amount type of crude gasoline coming from Europe into the U.S. theater. Then when we look at just how much, here you can see that we are at a record high for 2021 and a seasonally adjusted record high, as where I think the record was back at the end of August. I forget which year, but you can kind of see from the top of the cloud. It's just based on where European demand is, as we showed in the second segment. European demand is falling based on German, Italian, French data. UK is getting a little bit better, but again, this is going to keep that pressure over here. Switching over to Singapore, you can see that total products continue to trend higher. But when we look at the average, they normally trend up. It's just they typically start to flatten out and you start to see some of these draws. It's just we're not seeing that data right now where we continue to see these builds, and we think that we're going to push back to that seasonally adjusted high as we get to the beginning of April. And the one thing that has been slightly, pretty positive was middle distillate. We're back off of those all-time highs, but we're still setting new seasonally adjusted highs as we continue to kind of flatten out. And as we've been saying, we think that we're just going to kind of wedge back and forth at the top of this cloud, making those new highs, but not really falling back down, just because there still remains a demand problem on a global level. Then when we look at gasoline, so it's cheap to say, but based on this dip, it's seasonally adjusted all-time high. But as you can see, it's right at the high for 2021. That's something that's going to remain given the pressure that we see in India, pressure that we continue to see in South Korea, Japan, as well as China. Again, just kind of keeping and capping some of these flows. South Korea is sending stuff into the U.S. because the U.S. has a better market, especially because Pad 5 continues to reopen. Pricing is getting very strong, as we showed in segment 2, and just the numbers make sense at this point in time. Now, the Brent time spread shifted. Now we're in May, June. You can see that it's come under some pressure as we have some of these large bills coming through. The dollar still remains elevated. We're waiting for Powell. We're going to talk about that as it comes due, because he is speaking today, and there's going to be a lot of commentary around what does that mean, and then what happens with the dollar. Then when we look at Singapore refinery margins, we're still pushing pretty much negative, which again is just showing why there's going to be that limitation on oil demand, is as storage remains elevated. You're not making all that much money, so you're still going to remain depressed as we go into the end of March, beginning of April. And here you can see just how bad it is when we look at hydrocracking refinery margins. Again, no incentive to just activate or run anything above where we currently are. You have a ton of product in storage. You have crude that's very expensive. Why are you doing anything outside of just trying to maintain kind of this low level, just so you don't have to turn off and just keep things operational as much as possible? Urals have been bouncing around. You can see when we had those cheaper prices come across, we're still holding fairly tight, and just given where things are, this is something that we think is going to continue to roll down unless we continue to see pressure in the oil pricing field, just because there's just not that demand on the refined product side, which again is going to kind of cap some of those upward movements. Then look at the Mediterranean. You have that bifurcation that still remains very prominent as we look at the FCC, just showing you kind of where things sit. The topping remains the biggest problem, with the FCC kind of holding steady at that really zero. But the problem is that topping side, and that comes to gasoline, that comes to octane. That's where we continue to see this pressure, which is why the U.S. seeing an increase in demand as we go along the seasonal norms is going to be provide a stronger opportunity to try to send some of that excess gasoline into the U.S. markets. China's supertanker crude imports have started to increase. This is again going to result in just more floating storage in this area, especially as we have already a record amount of storage in the region. When we look at refinery run rates and Shandong, they've started to slow down. They're down about 2%. This is something that they're going to continue to slow as we have turnarounds coming through, again, eating into some of that demand in general. Asian floating storage still remaining off the lows. This is something that, again, we think is going to continue to go sideways, but what we think it's going to start to push towards the upper end of that range as we continue to be at the well above the 5-year cloud. North Sea saw a drop down just based on we had some cargo sell at a discount versus where they previously were, which has put some into transit. We have some loading schedules coming down a bit, so this is going to keep things above the 5-year average. But again, it's going to follow this 5-year trend for the most part, just remain at a fairly elevated level. West Africa had a strong bounce off the bottom. That's something that we think is going to continue to push up as we have those demand issues coming out of Asia, which is why we see those discounts. In order to keep the floating storage low, those discounts are going to have to continue to increase. Now, the Middle East is more on the concerning side. So we thought that there was going to be an increase. Now we're starting to see it. This light blue line really kind of shows how we are pushing towards the upper end. And just given where Saudi Arabia is on their export side, some of these loading schedules, some of the slowness in selling Iraqi crude, this is going to keep this elevated. We think there's going to be a pause. This is going to go either a little bit down or kind of sideways. But again, it's showing some of that excess that remains in the market in general, with Europe still remaining at those highs. But as we saw that some of it coming from European floating storage into onshore storage, but that those issues will remain in terms of just demand on the in the European theater. And here you can see that as of 2021, China's Shandong crude stocks are back to all-time highs. And just given where things sit as refinery throughput starts to come down, we still have an excess of storage. This is going to continue to push to those all-time highs. And then on the demand side, when we look at fuel oil stock, they continue to set a new record for 2021 and a record for just the last 5 years, which points to just what we're seeing on the industrial production side, on the investment side. And it's something that we're going to talk about as we go into the econ show. So hopefully this was helpful. I know there was a lot of information, a lot of moving parts, because there was a lot of, kind of conflicting data and movements as to where do we go from here. So leave us comments. We love the back and forth. Please like, share, subscribe. Your support is always appreciated. And happy St. Patrick's Day. So I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.